Great. It's 12:30 on a Friday. The sun's shining, and it's the last of our small caps Encore. So popular was the first block of small cap presentations we did that we've done three more, and the final one of those is from Chris Berrier at Brown Advisory. Chris has been managing the trust for just over 3 years, but he's been managing a very similar strategy for many, many more years than that, and has a really deep insight into the dynamics of US small caps and the companies that he invests in. It's a really interesting time for UK investors looking beyond UK investment because suddenly we've all forgotten about currencies as a thing you need to think about, but sterling has risen quite strongly this year, and so all the things Chris is going to tell you about why small caps are cheap and how that creates an opportunity are kind of topped off by the fact that a sterling-based investor can buy a little bit more of them than they could have done 6 months ago. And so with that, I'll hand over to Chris. And before Chris starts, just to say, put questions in the Q&A box. I'll read those while Chris is talking, and then there'll be a chance for me to ask those and have a conversation with Chris after he's presented. Over to you, Chris.
Yeah, thanks, Alan, for the intro. Appreciate it. And thank you, everybody, for joining us today. Pleasure to be here to spend 15, 20 minutes talking about what's going on in the small cap landscape and try to do it in the context of what we do and how we think about things as asset managers. As you likely know, our firm is based here in Baltimore, has a significant presence in London, but really now has offices all over the world. So our purview is not just sitting here staring at small cap stocks in the US, it's staring at the markets on a global basis and then trying to put things within their relative context on behalf of our clients. When you think about our investment philosophy, it's relatively simple. It's to harness the power of compounding. We buy businesses that are young, dynamic, hopefully led by good people, both as managers and in terms of culture building. And we hope to own those businesses over a prolonged period of time. So things like Waste Connections is a trash management company or waste collection company that we've owned for well over a decade since the financial crisis. Casey's Convenience Store is a small operator that is based in the Midwest that's grown into the fourth largest pizza chain in the country by serving pizza inside the restaurants. We own Charles River Labs for about a decade as a contract research organization until we sold it a couple of years ago. And we have businesses like a Dynatrace, which does network observability and application observability for some of the largest companies in the world. We bought it on the IPO a few years ago and have been upping in our position and decreasing it based upon the volatility of the stock. So that's a smattering of examples of things we've owned, and it just speaks to the fact that we're long-term investors in what is increasingly a very, very short-term world, because we think that's a good path to outperform the market on a risk-adjusted basis over a full market cycle. This is our team. I won't belabor this for the sake of time. It is a fairly large and deep team. I think we do our very, very best as we've gone larger to try to make sure that we stay small and nimble as well. And then finally, what are we looking for in the businesses that we buy? We're looking essentially for long-term compounders, and so that's durable growth, it's sound governance, and it's scalable go-to-market strategies. So we want to find businesses with a large addressable market opportunity relative to the revenue base of the business. We also want to see them do something differentiated, product, service, business model, culture that allows them to take a larger slice of a growing pie. we want to make sure that, again, we're invested with people that are incented the right way. That starts with having the right people around the board. It also means that you need to have the right people at the executive levels in order to scale up and grow the company. We are invested in businesses that at times are below their target business model. They need to grow into it. And so there's a lot of these foundational activities that need to take place in order for the business to scale up and hopefully achieve its potential long term. And if you don't have the right people in place, tackling a growth opportunity in front of them, you're not going to get very far. And then go to market is really about how does a business grow and scale. So if you think about it, what we're doing is really trying to anticipate not what a business is today, but what it will be in 3, 4, 5 years. And the way you do that is essentially looking at the unit economics of the business now, and then thinking about as the number of widgets sold grows over time. So from 100 to 1,000 to 1,000,000 to 1,000,000,000, what does that do based upon the incremental contribution of $1 in revenue? And that's why we talk about the go-to-market strategy. How is something priced? How is it packaged? How is it distributed? And then what are the intended returns and the margins associated with those activities, and how capital efficient is it? If you take these things, you put them together, we think these are the ingredients necessary to go on and become a long-term compounder and go from the land of small cap to the land of maybe, if you're a little bit lucky, large cap over time. So let's dive into small caps very quickly, and then we can get into your questions in a few minutes. Why am I attracted to the area? One, the companies are vast. We have a very large and dynamic universe of businesses to look at. There's 2,000 plus companies. They vary in their sector exposures and their subsector exposures. There's a dynamic nature to it. Every year, there are businesses flowing in and flowing out via the IPO market and via the M&A market. You've got companies that are large that drop to small. You've got divestitures that occur. And so there's always change. So even though I've been managing a portfolio for 18 years, you're never looking at the same set of companies. You build knowledge, you understand your universe, but there's always changes at the margin for you to keep up with. And that's really our goal. We know hundreds of companies in the space. We've talked to hundreds of management teams every single year. But the trick is to try to make sure that you can find the next thing that could be a great potential investment that fits your philosophy and process on behalf of your shareholders. So why is this intellectually interesting? The average number of covering analysts for a small cap stock is somewhere in the mid-single digits, while people covering Microsoft, it might be 20, 30, 40, or 50. And for the average large cap stock, it's high teens, almost 20, covering that individual business. What that does is provide you an opportunity set. It's a little bit wider. You have more space to come up with creative information and analytics, just because there aren't quite as many people staring at those businesses. And in fact, there's a large swath of the market, that's relatively uncovered overall. The most interesting reason to invest in small caps is that even though the last decade has been a difficult one for small relative to large, small has underperformed, I believe, 8 out of the last 10 years. Over the very long term, small caps do better than large and mid. And the reason for that is simply the law of large numbers problem. Small caps are smaller, their revenue base isn't as big, and therefore the opportunity for them to consistently grow and get larger and larger is better than some of their large cap peers. If you go back and you look at the S&P 500 through time, you'll see that the names at the top of the list change. And there's a reason for that. The world changes, technological change is omnipresent, and the law of large numbers eventually creeps up on you. You get to a certain point in your life where you grow to a size where it becomes very, very difficult to grow. And once you stop growing, you lose a lot of your ability to drive cultural excellence, attract talent, et cetera, et cetera. And so it's really this law of large numbers problems, coupled with the fact that small caps tend to be a little bit ignored. Sometimes they're a little bit cheaper at the margin, and that gives you the ability to compound at a higher rate And the price of admission in small is simply higher day-to-day volatility at the individual stock level. So if you're willing to stomach a little bit more swings in the prices of your equities, you can get enhanced gains over an extended period of time. And you can see that both on the left-hand and right-hand sides of this particular chart. So we have been thinking about the small cap space, given its performance over the last number of years, very, very intensely. And what we started to think about is that the period of underperformance relative to large has hit a extended period. And that extended period has caused a few things to happen. On this slide, we talk about valuation. Now, I can't go so far as to say that small caps across the board are, on an absolute basis, absurdly cheap. They're not. But they're also not extended and overly expensive at this point in time. And whether you look at cyclically adjusted PE ratios or you look at forward PE ratios, what's interesting is that the quality component of the small cap space, which is typically more associated with the S&P small cap 600, is reasonably cheap compared to large. And it is the type of businesses that are occupying that specific benchmark that we typically traffic in. So to us, you're seeing a dynamic where valuations are reasonably good. They are very good on a relative basis. And what we're looking for is a catalyst for the performance dynamics of the market to change. So the catalyst here may be that the performance of the market has been extremely narrow over time. As you can see, there's simply a small group of businesses that have contributed substantial amounts of the return of the market. This has gotten even more intense over recent history. And we all know that companies like NVIDIA, have produced astronomical gains and currently represent a very, very large proportion of the year-to-date gain of the S&P 500 and other large cap indices. When you get to a point where market concentration is extremely acute, as it is today, and as you can see, it's worse than it was in the 1970s, it's a bit worse than it was in 2000. And this means that most people own the same things. And anytime you have a period of time where concentration of capital is severe, it sets up for the dissipation of that capital at some point in the future when conditions change. So when we look at this chart, which is showing small cap relative returns versus S&P concentration, our view is that at some point, and it's hard to know the exact trigger, this level of concentration will end. And when it does, there's a historical precedent that small caps generally outperform. And the reason for that is it's a part of the market that's ignored versus a part of the market that's overowned. And so capital flows really only have one way to go. And when we look at the market today, capital flows are intensely important to driving stock market moves, particularly in the short run. But we think this is perhaps more than just a very short-term thing that can happen to small. We believe it's possible for a movement of this type to cause enduring long-term leadership. There are a couple other things that are interesting as well. We have been in a period of high inflation for the first time in many, many years, but it is coming down, and that is part of the supportive conditions that have caused the markets to move higher. When you start at a level that is somewhat high and you see a decrease in the rate of inflation, that tends to be good for small caps. So you can see in these charts the absolute return on the left-hand side, you can see relative returns on the right-hand side, and you can see that when inflation is high, call it above 3%, and decreasing, it tends to be a good thing for the absolute performance of the asset class. It also happens to be a good thing for the relative performance of the asset class. So we like to think about these conditions in the context of who we are and what we do. And our view is that the market has fundamentally changed in the small cap space. We have gone from a period where the vast majority of the money managed in US small caps was done actively. It was individual stock pickers looking at fundamentals of businesses, weighing the possible future states and returns, and then investing against those views. And it would be people like me buying and selling from other people that have a similar role, assessing fundamentals, coming up with a view, and investing against it. Today, the market's different. Over half of the capital in small caps is now passively managed, whether that's indices, ETFs, or other type of baskets. What this means is that there is a larger and larger proportion of the capital at play in the space that is not really focused on long-term company fundamentals. It's focused on other things, exposure buying, trends in the marketplace, momentum, could just be flow driven on any given day. It could be long short actors, curing imbalances in their portfolio, or it could just be people buying an ETF for the sake of getting, a foothold into the small cap space. If you have a larger proportion of the market that buys companies, not because of their fundamental conditions and their price or valuation or return dynamics, you can create inefficiencies in the market. And so our view is that as the proportion of passive continues to grow and grow and grow, over time, it is going to cause more and more distortions in the market. These both represent, short-term things that can change very quickly. But what you have is long-term opportunities around potentially mispriced equities, either to the extent they're way too expensive or perhaps way too cheap. And so our job as, bottom-up fundamental investors is to go out, canvas the universe, and try to uncover some of these inefficiencies and invest against them on behalf of our clients. The other interesting thing about the small cap space is that the number of businesses that don't make any money has continued to increase. So if we played this out even more, post the reconstitution of the Russell, it would even be higher, I believe, than the current line suggests. The reason that we've seen this change, and you can see it from sort of the 06 timeframe to now, is that yes, there's a change in the economy, but there's also a change in the structure of the markets. You tend to see companies that are successful get bigger faster, and then those companies have to be replenished in the small cap space. And typically what's leaned on is a number of relatively early, smaller companies, less liquid, lower stock prices that end up filling the bucket when some of these larger names move on into the mid cap and large cap areas of the market. This has caused a persistent trend dominated by the healthcare sector, frankly, of more and more businesses not making any money. This is also exaggerated, obviously, by a period of time where money was free. And during a period where money is free, people were willing to fund losses nearly into perpetuity. And that caused more and more companies to be born with the mentality of, if you build it, they will come. And so there was a huge emphasis on growth versus trying to get to profitability earlier. Not saying that that view is wrong. It's just what has happened in the world. And this has led to a higher and higher proportion of non-earning businesses sitting in not only the Russell 2000 growth, but the Russell 2000 overall. And so when we think about the world, there are a couple things going on. There is a giant move to passive. There are more and more companies in the small cap space that don't make money. There are people acting in a manner that isn't largely reflective of the fundamentals and valuations of the stock, but more just buying exposures. And that creates a fertile hunting ground for us as active managers. We are looking to go out there and try to position the strategy again for the long term against a universe of companies that's large, extensive, perhaps undervalued relative to large, and set up well, in our view, for a period of sustained outperformance when the dominance of a few large cap companies eventually fades. And if you're a student of history, you will see that over the long term, these periods don't last. And so our contention is that while we can't point at a specific catalyst, we believe that the level of concentration, the gap in the valuation between large and small, the fact that earnings conditions are improving on a relative basis as well, all set up for a period of solid small cap performance in the future that could run as long as 2, 3, 4, even 5 years, coming off a period where large caps dominated 8 out of 10 years. So I'll pause there and happy to take any questions at this time.
Thanks, Chris. I thought we might start by trying to fulfill the pent-up desire of the audience to know about politics by asking a very different question related to regulation. So, I mean, you've mentioned it's a well-known theme in the UK small cap market as well that the opportunity lies in the lack of coverage. And if you do your primary research, then you might be able to identify something that someone else hasn't spotted. And there's a kind of easy to understand commercial reason why there's less research on smaller companies. But in the UK and Europe, some of that was compounded by regulatory changes, which in fairness have been walked back on a little bit, but it has left a lack of research amongst the very smallest companies. In the US, is that if you were given a legislative agenda or a regulatory agenda to change something, either to remove a barrier or to put a barrier in place, to improve the coverage of smaller companies, then what would that be?
I think that you would make it more expensive to trade them. I think that the reason the business has changed and the reason you don't have, preponderance of small cap coverage, it used to be that the businesses were relatively unknown. They didn't have a commercial gathering. There wasn't as much information available to them, and there weren't as many people, out doing the job of gathering information and producing it. Today, we have a flood of information. We have computers that are grabbing it every which way and distributing it all around the world. But what's happened as the technological advance in the equity market and the dissemination of information has become virtually universal is that it's gotten cheaper to transact in the stock market. So spreads have compressed. And so really it's a volume game. And when you're in a volume game, you've got to go where the volume is, and that's up cap and large. And so I think versus having a real view on the regulatory dynamics that are causing it, I think it's really just the nature of the business. It's the underlying economics of the buy and the sell side that have changed over time, and it's caused different points of emphasis. And those points of emphasis have favored large cap companies over small simply because they're more liquid and you can trade more of them. And so I don't have a specific prescription of some sort of regulatory thing that would prompt more coverage. And I think that, in fact, when you have a market that is dominated by people buying passive alternatives versus individual stocks, it compresses the need and desire and economic rationale for producing a lot more individual stock research, which is why, our view is that even though the market can can still be relatively efficient given the amount of capital flows out there, I would say that the chances are, as we continue to move into the future, the amount of passive money going over 50%, and the fact that I don't see the amount of research going up, it may actually go down. Um, that leaves open opportunity for people, with a well organized and appropriately deployed team to try and gain an edge in looking at the businesses. And we think that, inefficiencies exist informationally, analytically, and behaviorally. I think informational advantages, just because of the fact you can hit a button on FactSet or Bloomberg and get all the information you want, have probably declined over time. But I think analytically, by thinking long term and then behaving a little bit differently than the broader market, that's a larger opportunity perhaps now than it was in the past.
Mm. And I mean, obviously, this meeting is an example of how technology allows people to connect and gather information firsthand in dare I say it, a more a less short-term trading fashion. Are there pathways for US smaller companies to kind of promote them, promote themselves to investors? In the UK, we have a pretty good ecosystem of Kepler doesn't do direct equities, but some of our peers do direct equities and allow management to talk directly to retail. Is that something you would encourage your companies to do, or is there an ecosystem like that, and does it
Yeah,
work?
I think I would encourage them to run their businesses well,
Yeah,
versus
of
spending
course, of
too
course.
too
Yeah,
too much time,
of course.
promoting their stocks. I mean, at the end of the day, when you're a public company, you do have to tell your story. You do have to help people understand why you're making certain investments to be transparent. But stocks eventually follow the financial performance of the company. And yes, valuations can swing quite markedly, but over the long term, they're smoothed against the generation of your cash flows and people's views about the future of your cash flow growth. So I think for a lot of these companies, they are actually accessing and speaking to European investors more than they would have 10, 20, 30 years ago, specifically because of tools such as this. You also see that there is an emphasis in the marketplace on, global strategies, managers trying to access different pools around the world. And so there's a pretty solid infrastructure of conferences, et cetera, that go on overseas, particularly in London, that allow, European, UK investors to see these businesses. They go on road shows frequently. And the other thing to keep in mind is that they're doing this perhaps not as a distraction to running the business, but because their businesses have changed. And what I mean by that is that as a small cap company today, because of all the technological tools that we have, it's simply easier and you're enabled to go global faster than you otherwise would. If you're a software company, you can stand up a small office somewhere in London with a group of salespeople and sell your product and do a bunch of live webinars or demos from the US with the rest of your sales force. That really didn't exist as when the number of software companies was smaller, but it's proliferated, in spades over time. And so we've seen this nice steady drumbeat of smaller caps garnering slightly higher proportion of their revenue from international markets. And I think that gives them a reason to be in those markets and interacting with, investors that might not necessarily be sitting in the US.
Yeah. And there's a few kind of sector and metric questions which we can come on to. But just to conclude that, obviously governance is one of your three Gs, and we sort of touched on a little bit of engagement already. But do you want to talk a little bit about how what Brown Advisory is a big investor in smaller companies. You're not 2 basis points of a company share register, are you? So do you want to talk a little bit about your approach to how you engage with companies to encourage them, or where it might become a more confrontational even?
Yeah, absolutely. So we are actively engaged in the businesses that we follow, but we're not activists. Um, if we believe a company is on the wrong track, they're making bad decisions, they're allocating capital poorly, we are not going to go in, buy up 10% of the company and try to force change. We're going to say that we believe this management team is going down the wrong path, and therefore we're not going to partner with them and travel down that path. The typical flow of our interaction with the management team is an initial phone call with maybe the CFO or the IR to get to know the business. We then escalate and have a series of other meetings, whether in person or on the phone or a WebEx or Zoom, that goes to the CEO. We will often try to figure out a way to talk to a couple of members of the board, if possible. We usually go visit the company prior to making an investment. We talk to all their customers, we talk to suppliers, just to get a fulsome view of the business at hand. And once we have our understanding of the end markets that they serve, why their customers value their product and service, and what their strategy is, that enables us to hopefully be, you know, helpful, fair, both supporters and perhaps critics of the choices that are being made at a specific business. And so some of those happen to be around investment, could be in sales and marketing, could be the volume of dollars devoted to certain activities relative to what we think makes sense. It could be the amount of capital being spent or put in the ground for a particular activity that we don't know if it's going to have the payoff that the management team wants. And then I think most commonly, we spend a lot of time talking about uses of capital, M&A strategy, what makes sense, what doesn't, share repurchase, dividend policies, things of that nature that we think, if you do it right over a long period of time, can enhance the value of a business by perhaps 2 to 3 points per annum. And so we have an ongoing dialogue with the management teams. We're not there to be friends. We're there to have a mutual relationship where they understand that we've spent a lot of time getting to know and understand the companies that we're invested in. We spend a lot of time trying to understand the markets and the competitive threats, and that when we have a issue, we bring it up in a respectful manner, and we hope to build enough trust and understanding with the management team that they're willing to hear our views. And then what they do with the information that we put in front of them or our thoughts, that's going to be dependent upon what they're hearing from other investors and what they believe is the right thing for the company. So we're very active, very engaged, but we are not activists per se.
Mm. Yeah, thanks, Chris. There's a few questions that I would summarize as being about the kind of operational and risk side of things. So do you want to talk a little bit about the sectors that you tend to favor, and maybe is there anything currently that's different to your kind of long-term preferences, and then just discuss a little bit about things like the liquidity of the portfolio, and your kind of risk framework in terms of having to sell companies if they move up to the senior index, and all of that kind of thing. And of course, Basque sits alongside some quite big funds run in a similar way. So is there anything that sets the trust, which is with the closed end nature, that that sets it slightly apart from your other mandates?
Yeah, happy to hit on that. So generally, we do our risk management initially at the company level with the underwriting criteria that we have. We're looking at upside relative to downside. We're looking at the number of known risks that exist in a business, and we're trying to balance them equally. So one eye on returns, one eye on potential loss, and try to make decisions based upon risk reward. We do this in the context of having a largest position side of 5%. So we sell once something gets above 5%. We had to do that many, many times with Waste Connections and a few other businesses. But again, that's pure risk management, so that, one of our businesses, if we are, wrong or something unforeseen happens, can't sort of fundamentally damage, the portfolio too much. When we think about sector exposure, um, we try to know and understand what's in the benchmarks, but we are not necessarily beholden to them. We're aware, we're conscious, but we don't follow. However, given the fact that we are trying to find businesses that can compound, we do tend to gravitate to certain areas of the market: technology, healthcare, and industrials in particular. So if you looked at our portfolio, you're likely to see 20% plus or minus in those three areas of the markets, perhaps more, even given some of the changes in the underlying benchmarks, and the constitution of the small cap space over time. We don't allow, it's very atypical for a specific sector to get up around 30%. Typically, they cap out at somewhere in the mid 20s in terms of overall exposure. And when we look at that exposure, we try to understand it in the context of the individual constituents. So, if you have 25% in technology, you probably don't want to have 25% in software. And so we try to do both diversification at the highest level, which would be sector allocations, but then diversification by subsector, economic sensitivity, valuation, balance sheets, you name it. And I think we've spent a lot of time trying to analyze and think about diversification as a tool to manage risk. The liquidity profile of the portfolio is pretty darn good for a small cap portfolio. Some of that comes from the simple understanding that as you buy small cap companies and they grow into mid cap status, generally the liquidity profile improves versus deteriorates. And so because of that, as our companies are in the portfolio over a multi-year period of time, the liquidity profile picks up, and that helps us in terms of the overall management of the portfolio. We do have to consider, how much of a business we own. So we monitor when we go above 5% or get close to 10% ownership. Typically, high single digits is where we top out. It's very rare that we go above 10% at the individual company level. We think about what percent of float we are, days to enter, days to exit, all of that. And within the context that we know that the market is dynamic and things change, quite frequently. In terms of just the overall strategy, we took over management of the trust at a very interesting period of time. It was 3 years ago. It was in the throes of a rally that was fairly late in innings. Sorry for the baseball term. And we wanted to be conscientious that valuations were stretched and the market had gone on a heck of a run following all of the Fed-induced cuts due to COVID. And so because of that, we were a little bit careful in terms of, how concentrated the portfolio was going to be, leverage employed, illiquidity, things of that nature. I think the good news is that period is past. The extensive overvaluation of small caps is gone. And we're now in a period where small caps are reasonably valued. I think earnings, we can debate the trajectory of the U.S. economy ad nauseum, but we think that earnings, will, while they might have had a little bumpy run here with minimal growth of late, seem to be balancing out. The comparisons get easier and the economy continues, albeit slowly, to grind forward. The conditions are just very different. So we have the wherewithal within the trust over time to make it a little bit more concentrated, to have position sizes that are slightly larger, and to employ selectively and carefully a bit of gearing into the portfolio. And so while we haven't taken that on in earnest yet, it is something, given the change in conditions in the equity market and the fact that valuations are better, that we would consider, particularly in light of the fact that we do believe at some point in the future, small caps will go on a nice relative run, and we want to do the very best we can to position ourselves favorably for that run, should it start to occur over the next year or so.
Thanks, Chris. I'm going to tiptoe around politics again and just ask, maybe as a final question, these two words, globalization and deglobalization, that are used quite freely to describe incredibly complex interconnections, but I think it's not unfair to say the story of the 21st century is first half globalization, second half deglobalization. And we see in Europe, alongside the complexity and the kind of political angst around that, we see companies creating real opportunities from that. Obviously, the US is a continental economy where small caps maybe aren't so outward facing, but maybe they are, and maybe this is an opportunity. The political point, I suppose, is that there is a story arc to come where deglobalization becomes an even greater trend, isn't there? So I think it's a kind of interesting thing to think about how it has been positive potentially for companies already.
I think that you're absolutely right. The benefit of globalization was essentially, you know, making things cheaper and faster, and leveraging, resources around the world instead of in your local economy. And those forces have been deflationary for a long time, and it helped to offset what might have been a reasonable amount of money printing around the world over various periods. The inflation that we've seen of late, maybe it was just too much money printing. Maybe it's due to the fact that, we've gotten to a point where some of those trends are starting to reverse themselves, and the markets are smart enough to understand it. And I think that it is fair to say at this point that, due to the geopolitical tensions between the US and China, and the fact that we've gone through multiple supply chain disruptions over the last several years, people now are weighing both the benefits of globalization, but also the risks. And I think when you start to think about the risks, you then are willing to accept the higher cost of doing things perhaps closer to home. And so we believe that nearshoring, onshoring, and perhaps building up of the US domestic manufacturing, supply chain, and infrastructure is a real thing. And we've made a few investments against that thematic. We don't invest in themes, but we do believe that both bringing production closer to home, and then building the intended infrastructure that is needed to support that or modernize that infrastructure are things that have a long tail to them due to a number of decades of underinvestment. And so whether it's in industrial distribution businesses, whether it is, you know, HVAC machinery or things of that nature that go into building these manufacturing sites or distribution centers, um, it's real. And our view is that it's real and it also might cause inflation to be a bit more sticky than people think. And so we are in the camp that, whether Trump wins or not, more things are going to come back to the US. It's going to lead to more opportunities for a select group of companies. It's our job to go through those businesses, particularly in the industrial, consumer services, or commercial services landscape, and pick them out. And then to think about what is the economic ramification of this trend and how is it going to impact the rest of the portfolio? Inflation higher, rates maybe don't go back to the zero bound, multiples maybe stay a little bit lower. What does that mean for M&A, et cetera, et cetera, et cetera? So this trend that you've pointed out of sort of globalization and then deglobalization due to some geopolitical tensions and supply chain disruptions is one that is not only important for individual and specific investments, but I think investments in general. So we have been spending more and more of our time, looking at companies that, have harder assets, are well-run capital light businesses, but have, harder assets, might be a little bit of an inflationary hedge overall, not playing for an inflation theme, but just higher for longer. They might be more advantaged than some other companies. So multifaceted, I guess, outcome or consequences of what you pointed out. And I do believe it's a real trend, and it's probably one that, should former President Trump occupy the White House one more time, it would probably be a trend that is even more, omnipresent, and there might be some regulatory support through lower taxation around specific investments that are made in the USA.
Yeah, thanks, Chris. I think with that, we'll draw things to a close. I should have said at the outset, we're actually delighted on the day of what appears to be the largest global IT outage ever, that everything has worked smoothly. And in case anyone's wondering, no, Chris doesn't own CrowdStrike, the company that seems to be responsible for the whole thing. I confirmed that with him earlier. So we seem to have sailed through this particular IT issue today. Chris, really appreciate you getting up. I know it's quite early Eastern time, so really appreciate you taking the time so
Yep.
early on a Friday. And
Yep.
for everybody, this is recorded, so you can watch it again, and the slides will be available to download as well. And of course, the Trust's website has all kinds of useful information, and of course, so does Kepler's, and you can look at both of those at your leisure. And with that, I'll thank you, and we'll see you on the next one.
Yep. Thanks, Alan. Appreciate it.